X-ray a shortlisted stock to confirm its quality with speed and accuracy. What are the necessary and largely sufficient data points to look at to build conviction about a shortlisted opportunity? How a structured report will make it easy to analyze and give useful insights into the stock and you get better at it? What is required to feel confident about the future performance of the company? How do you do this without having to be an expert in financial data analysis? The quality fast tag on stocks provided by MoneyWorks for Me helps you quickly identify investment worthy stocks. But you need a way to confirm this for yourself so that you can invest in them confidently. However, this should be something that you can do with speed and accuracy. As a retail investor, you don't have the time, expertise, and passion like Warren Buffett to sit around every day and study annual reports so thoroughly that you know more about the company than its overpaid CEO. Luckily, you don't have to invest the amount of money that Warren does in any one stock. So, you need a very good fit for purpose but accurate reading on the stock that enables you to make an informed decision. You should be okay with missing out on a few potential turnaround stocks and future winners. But you want to avoid investing in a weak company. Remember, you will make your desired healthy returns on your portfolio even if you miss a few winners. But buying more than a couple of loser stocks will adversely impact your returns. 4 financial parameters over 10 years, in addition to the decision rating, tells you one heck of a lot about the company's quality. They are earnings per share or EPS, net sales, book value per share or BVPS, and debt to operating cash flow. Let's see how. What is earning per share and why is it so important? What is the first thing that you look for in a company before investing in it? Obviously, whether it is making a profit consistently. What you should see is profit after tax or PAT, which is what the company and its shareholders get when all is said and done. When seen on a per share basis, this is known as EPS, which tells us what profit you earn on every share that you own of the company. Why is this important? When you put your money in a fixed deposit, you get some interest on it. Let's say you get 7%, which means you get 7 rupees a year for 100 rupees invested in the fixed deposit. In addition to a promise from the bank of getting back your rupees 100 at the end of the term of the fixed deposit. EPS by price, also called the earnings yield rate, is the equivalent of the interest rate. This is earned by the company and its owner. It tells you that a company earning an EPS of 7, if available at the price of rupees 100, has the same earnings yield rate as the interest on FD. The more popular ratio is price by EPS or PE ratio, which is the inverse of the earnings yield rate. But why would you pay more than rupees 100? The fundamental reason could be that you expect the company to earn more than 7 rupees next year. For this, you need to see how well has the company grown its EPS year after year. This is so important that we have provided color codes for the yearly EPS growth rate on the company's 10-year X-ray. When it is green, it means it has clocked a healthy 12% plus growth in that year. If less than 8%, it is colored red, and it is orange if it is between 8 and 12%. Seen over 10 years, you can easily conclude on its profit track record. Companies with a track record of consistently earning increasing profits are obviously more valuable. What you're seeing on the screen is for Britannia. But can you decide to invest based on a company's reported profits? No. Profits can be misleading for various reasons. One reason is that a company may require some of its profit to run its business. Then the profits reported are not really the same as the profits available to the shareholders. Net operating cash flow highlights this. It is the actual cash generated by the company from its business and excludes cash required for its working capital. So, if a company's operating cash flow is consistently lower than its reported profits, it needs more cash than the profit it earns to run its regular business far too often, and hence it should not make it in your shortlist. You can see the net operating cash flow for 10 years on the Money Works For Me company page. For Britannia, the last 10-year numbers, you can see this is quite fine. Further, when you also remove the capital investments made, you get the free cash flow of the company. That is what is available to you as a minority shareholder. This is used in the decision rating on quality. You can see from Britannia's decision rating that the quality is green or very good. But how do you know if a company will grow its profits consistently? A company can increase its profits by selling more every year. So you need to look at the company's net sales and check if it is growing consistently at a healthy rate. Sales can grow with a higher volume or a higher price, preferably both. Growth in volume should keep pace with the growth in demand for the category. For example, if the demand for paint is growing at 6%, then the minimum growth rate required to maintain market share is 6%. Secondly, prices should reflect the effect of inflation. Only when the total cost increase is passed on to consumers will the company maintain its profitability. So if the paint company encounters an inflation of 4%, then its net sales must increase by a minimum of 6% plus 4%. That is 10% to maintain a healthy growth rate. When a company's sales grow year after year profitably, this indicates that this is a sustainable moat. To increase sales in the long run, a company needs to invest in itself. But how do you know that it is doing so? Many companies plow back some or all of the profits back into the company to grow their future profits. To exploit the opportunity in the market they operate in, they may need to expand their capacity, fund the increased working capital, etc. BVPS or book value per share will tell you how much a company is investing in itself. Some companies do not need to reinvest to keep growing at their current growth rate, and they probably do not see the possibility of growing through some other businesses at the same level of profitability. These companies, at least the ones with trustworthy management, pay out a substantial portion of their profits as dividend to their shareholders. These are attractive to some investors for the dividends that they pay. Alternatively, some companies buy back their shares, as was done by TCS and Infosys. This benefits current shareholders as it increases the EPS, and as we saw, the market rewarded them with a higher share price. When you see all three, sales, EPS and BVPS growth numbers, you can infer if a company has performed well. If the sales and BVPS has grown faster than EPS, you would not be very pleased as an investor. But slower sales growth would be even more worrisome. You can see these numbers CAGR for 1, 3, 5 and 9 years in one neat table on the company page. It is rare to see a company with all its boxes green, but if most of them are, you can be pretty sure it has a strong moat and a sustainable competitive edge. Here is one for Titan. Now coming to how a company handles debt. Debt is described as a double-edged sword because it is a cheaper source of funds than equity, but leads to severe problems if it is overdone. So how do you know if a company is overdoing it? Debt is cheaper than equity, but when does it signal a problem investors want to avoid? When a company borrows money, it should be able to repay it, that is the interest and the installment of the principal amount, without serious difficulty in a reasonable period of time. Debt to operating cash flow tells you the number of years in which the company will be able to repay its debt out of the cash generated from its business operations. When this ratio is high, it means that the company will take a long time to pay off all its debt and hence will pay a large substantial portion of its profits towards this. There will be less left for shareholders. And very importantly, in case of any challenges, example an economic slowdown or a worker strike, it will face a crisis of default, the one thing that can send the stock prices crashing. A ratio of less than 3 is considered acceptable. There are some notable exceptions to this thumb rule. Example, utility companies like NTPC, where projects take longer than 3 years to go live. When such companies are either backed by government guarantees, contracts, etc., and also have near monopolies in their industry, then the high debt may not necessarily be a problem. However, you need to see the trend and get assured that the company has a track record of executing projects on time and a plan of reducing debt systematically. You can see these 6 financial parameters in one place and in an easy to understand manner. You get confidence on whether a stock deserves your hard-earned money and you can ignore the rest. Once you understand what this table contains and get used to it, the colors and the numbers help you confirm the quality of the company with speed and accuracy. There are a few more things to see about a company once they are seen to be investment worthy on these 6 important parameters. And the key ones are on the company page. You can use the tooltip available to understand them better. These include 1. Other key financial parameters like return on equity or ROE, margins, debt to equity and working capital. 2. Recent performance summary, which tells us in short how the company has performed on 5 key parameters in the last 3 years in an easy to understand way. 3. Latest financials and quarterly performance summary. Here you can check out the company's latest numbers and the market related data. In a separate table, you can see the performance over the last 4 quarters, which helps you assess the most recent performance. Poor performance in multiple quarters could indicate a more challenging problem. 4. Management X-ray. This tells you whether a company's management practices instill trust. This can be concluded from its rating on 5 factors, as can be seen in the image. However, this is not easy to rate and hence is available for select companies only. What is available for all companies is the shareholding patterns and whether the promoters have pledged their holdings, which is a red flag situation. Number 5. Graph for the key numbers. A visual representation of the key parameters over 10 years is easy to understand. News and analyst notes. News enable you to stay informed, while analyst note helps you understand events better and know what our analysts have to say about a stock. And lastly, something about the company. Banks and non-banking financial companies require a different set of ratios than other companies, essentially because their raw material and their final product are the same, that is money, which they lend and they do not sell. This I will explain in the next session. Thank you.